So what we have seen this time is that actually a lot of the tax changes and the policy changes have actually been announced prior to the presentation of the budget. So we've seen the WHT tax being increased, we've seen the changes on the payee side, we've also seen vehicle import duties and so on being announced, and also in terms of excise duties on some of the products as well. So in terms of the market expectation this time, there's really not much that the market is expecting to change as a result of the budget. What they're looking for this time is actually a lot more in terms of the signaling effect. What they're looking for is really in terms of policy consistency. What will happen in terms of the actual fiscal targets? Will they be on track in terms of maintaining the fiscal consolidation path that they've been on so far? Primary surplus, will they hit the 2.3% that is expected to be seen by the IMF at the end of 2025? So these are the signals that they will be really looking for, and as long as these are kept intact, the market will take it positively. I mean, if fiscal targets are met and inflation risk is relatively low, what we'll see is there'll be less pressure in terms of interest rates, and that in terms of the equity market, given how low interest rates are right now, presents equities actually as a very attractive asset class at the moment. And if it stays that way, equities will continue to perform quite well. We've already seen the equity markets move quite substantially in the past couple of months, from just below 11,000 just prior to the presidential election to 17,000 levels now. So that's basically a 50% increase in terms of the overall index. So this factors in a couple of important things. They've seen the reduction in terms of political risk. They've also taken off the fact that we were seeing a debt restructure that was being negotiated, and that risk has now come off. And you're also seeing some level of political and policy stability that we're seeing as well. In addition to this, we are also factoring in the increase in corporate earnings going forward, and it's a market expectation that's already been priced in. So right now you're seeing this momentum that's already being factored in, so we don't really expect any change to really happen as a result of the budget itself. Company-wise, of course, they will be looking for certain indications in terms of what sectors is the government going to support, what benefits will they receive, and also in terms of what will be more negatively impacted. This can also have impacts in terms of specific counters or sectors that are listed as well. But a lot of these again have been communicated in advance. So the increase in terms of, for example, corporate taxation on alcohol and tobacco already announced to be effect from April 2025. I think the one risk that people are talking about right now is the possibility of a capital gains tax in terms of the sales of listed equities. This was of course mentioned in an IMF technical assistance report, so we don't necessarily think it's very likely to come in this budget, because it would really disincentivize investments in the equity markets, and the incremental revenue generated might not necessarily set off the reduction in possible transaction activity that you might see thereafter. One positive, of course, is that post the budget, we are likely to see the IMF board level approval actually coming through. So once the budget is done, what we might actually see is a positive impact on the equity markets as a result of the IMF board level agreement.